Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with part 3 of a 3-part video series on adjustable rate mortgages, a Fannie Mae refresher. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of Fannie Mae guidelines. Also, this video was issued on May 29, 2018, and the information contained in this video is subject to change without notice. So let's continue taking a look at the Fannie Mae ARM guidelines. All ARMs must meet Fannie Mae's eligibility matrix. And what we're going to do is we're going to take a quick look at the actual eligibility matrix. Now, I'm going to show you the live website, and depending on when you watch this video, the guidelines for Fannie Mae may be different, so just keep that in mind. Always refer to the most up-to-date Fannie Mae guidelines on their website. So here we are taking a look at the actual eligibility matrix, and we're going to go to here the first page, which covers the standard eligibility requirements for DU or loans underwritten by DU. Now the first thing I want you to take note of is over here on the right you can see where it says FRM and ARM, and you'll notice right off the bat that for a fixed rate mortgage the borrower can go up to a 97% LTV. If it's an ARM, they can only go up to 95%. So what you're going to see is that typically requirements for Fannie Mae loans, if the borrower is doing an ARM mortgage, they're going to be a little bit tighter. They may not get the same type of LTV or ratio flexibilities as they would if they were doing a fixed rate mortgage. So again, we can see here on the right, depending on the type of transaction, they can do an ARM loan on a purchase, a limited cash out refinance. They can also do it on a second home or an investment property. But again, you're going to see situations here where the ARM may offer a little bit less flexibility. So except here in the case of second homes, you can see a fixed rate ARM are going to be the same LTVs, same thing for an investment property. Now, if we scroll down and take a look at the home style renovation loan or manufactured housing or home ready, Fannie Mae does allow ARM rates on these, but again, in some cases, your max LTV is going to be capped at 95%. Then again, if we scroll down to manual underwriting, now in this case, it gets a little bit trickier. So let's take a look over here on the left. Let's say that we have a purchase transaction, a 1 unit. You can go up to 95% LTV with a fixed rate or an ARM. However, you're going to have some differences here when it comes to the credit score. So let's say, for example, that you want to do an ARM, but your credit score is 640 or less, then you're going to be capped at less than or equal to 75% LTV. So just make sure that if you're doing an ARM loan, that the borrower is meeting the requirements and that you're meeting the LTV requirements as well. They also allow ARMs on the homestyle renovation for manual underwriting. So pretty much all of their loans, they're going to allow for ARM rates. The only thing where you don't see ARM rates allowed is the DU Refi Plus and Refi Plus. So pretty much everything else is allowed. But again, just make sure that you check out the eligibility matrix whenever you're working on an ARM loan for Fannie Mae. Now, after the eligibility matrix, there is one final thing that I want to point out in regard to guidelines, which is ARM payment shock. So ARMs that have that low initial interest rate, which is going to be fixed, that expires after a short amount of time, then adjusts to a variable rate, can have a potential for a payment shock to the borrower. And payment shock refers to the impact on the borrower's ability to continue making those monthly mortgage payments after that introductory rate expires. So Fannie Mae requires that if the initial fixed rate is 5 years or less, then the lender is going to be required to qualify the borrower on a higher interest rate. And here's how this would work. So if the initial fixed rate is 5 years or less, the lender must qualify the borrower on greater of the note rate plus 2% or the fully indexed rate with a fully amortizing payment, including taxes and insurance. So that way they can avoid any potential payment shock. All right, that concludes this 3-part series. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. Have a great day. We'll see you next time. Bye-bye.